There are massive changes going into effect for 401ks this year. One of the biggest and most important of these changes is that employees who make qualifying student loan payments can now get matching contributions to their 401ks from their employers for these payments. This brand new rule is a complete game changer for people whose student loan debt is preventing them from saving for retirement properly. In today's video, I'm going to cover all of the specifics for this rule so that you know whether or not it applies to you, how to take advantage of it, and which companies are already offering this benefit, and much more. Before we begin, don't forget to sign up for the Tax-Free Wealth Challenge, which will be kicking off March 18th through March 22nd. Over the course of these 5 days during the event, I will teach you highly advanced tax reduction strategies favored by the wealthiest of Americans. There's a link in the description below to sign up and grab your ticket. I look forward to seeing you there. Now let's dive in. The Secure Act 2.0 is a bill that was signed into law by President Joe Biden in late 2022. This act made many changes to 401ks. I have another video where I discuss more of the changes from this act, so feel free to check that video out as well. The Secure Act 2.0 is the law that changed the 401k rules so that student loan payments can now be eligible for 401k matching from employers. Just so you understand how this works, let's just say that you're currently paying $600 every month for your student loan payments. Now, under the new rules, these payments would qualify for a 401k match of $600 every month or $7,200 per year from your employer. The reason why this change was created was because a large percentage of workers have student loan debt, and as a result, it is very difficult for many of these people to save for retirement properly. Here are some of the student loan debt statistics that demonstrate the problem. In the United States, U.S. borrowers owed $1.75 trillion in student loan debt, including federal and private loans. $28,950 is owed per borrower on average. 55% of students from public four-year institutions have student loans, and 57% of students from private nonprofit four-year institutions have student loans. And for many student loan borrowers, it can take 20 to 30 years or even more to pay off their student loans. Also, borrowers in certain states have student loan debt levels that are significantly higher than the national average. For example, the average student loan debt amount in New Hampshire, Delaware, and Pennsylvania is over $39,000, which is more than $10,000 higher than the national average. But what counts as a qualified student loan payment? At this point, you might be wondering, Karlton, does this rule only apply to federal student loans, or does it apply to other types of education-related debt? Well, the answer is that the new 401k matching rule for student loan payments applies to both private and public loans. In fact, qualified student loan payments are any payments on debt by the employee associated with higher education expenses. Whether you get your student loans from Uncle Sam or from a private lender, you should be able to qualify for 401k matching for your student loan payments. Now, are employers obligated to offer these benefits? Under current law, employers are not obligated to offer 401k matching for student loan payments. So, even though they are now able to, employers do not have to make matching 401k contributions for student loan payments of their employees. But despite the fact that they are not legally obligated to do so, it is likely that many companies will start offering this benefit to attract talent. For employers who do decide to match student loan payments for 401ks, it'll be up to them to decide themselves what percentage of their employees' salaries they will match student loan payments for. Now, are any large companies currently offering this benefit? A number of major companies have actually started offering 401k contribution matching for student loan payments. Here are a few examples of those companies. Number 1, Verizon. Telecommunication giant Verizon is now offering a retirement savings program called the Secure Your Future program. As a part of this plan, Verizon employees who enroll in the program are eligible to get matching contributions of up to 6% of their salary for qualified student loan payments. Verizon employees are also allowed to get the full 6% match for standard contributions to a 401k as well. So, if you currently work at Verizon, or if you end up working there in the future, then you can expect to be able to get 401k matching for your student loan payments, your standard contributions, or the combination of the two. 500 Verizon employees signed up for the 401k matching for student loan programs the first day that it was offered. So be sure to make sure you check this out if you're an employee of Verizon. Number 2 is Chipotle. Chipotle, who's famous for its tacos, burritos, and quesadillas, is another large company that has begun offering 401k matching for its employees' student loan payments. Chipotle took into consideration the fact that 73% of its workforce are members of Generation Z, when making the decision to offer this benefit. Student loan debt is an extremely important issue for young people because young people hold the majority of the student loan debt, and it often impacts their lives the most. So Chipotle's offering of matching 401k contributions for student loan payments can potentially help many of its employees. Under its new loan payment matching program, Chipotle will make matching contributions for up to 4% of its employees' salaries for employees who make qualifying student loan payments. Verizon and Chipotle are the two of the biggest companies that have started offering 401k matching for student loan payments. However, they are not the only companies that are now offering this benefit. Here are some other companies that have also implemented this policy in 2024. Abbott, which is a large healthcare technology company. Kimley Horn and Associates Inc., a consulting company for engineering and design, and s-corp, a media and publishing company headquartered in Manhattan. These companies are all ahead of the curve, and they might end up setting a trend as more and more employees and job seekers start to request 401k matching for student loan payments as a benefit for employment. If your company now offers 401k matching for student loan payments, and if you're thinking that you want to enroll in the program, then you need to understand what is meant by qualified higher education expenses. Earlier in this video, I mentioned that the new rule applies to both private and public student loans, but you also need to know that you can only get 401k matching for money that you spent on qualified higher education expenses. So what are they exactly? Higher education expenses generally refers to the expenses that are directly related to the enrollment or attendance at an eligible post-secondary school. Examples of qualified higher education expenses can include tuition and fees, books, school supplies, school-related equipment, and room and board. So in other words, it is not enough for you to simply have taken out student loans in the past to be able to qualify for 401k matching under the new rules put into place through the Secure Act 2.0. You must also have actually spent the money you received through your loans on qualified education expenses. If you took out $100,000 in student loans and decided to bet it all on GameStop stock, then don't expect the IRS to allow you to get matching 401k contributions from your employer for your payments on the debt. Now, will employers get tax deductions for matching contributions? With a traditional 401k match, employers get tax deductions for the amount of money that they contribute to their employees' retirement accounts through a matching program. The good news for you, if you own a company, is that the same tax deduction will apply to 401k matches that you make for your employees' student loan payments. So, if you decide to make matching contributions to 401ks for student loan payments, you will not suddenly lose the ability to deduct the contributions you make from your business's income. The fact that businesses can still get substantial tax deductions for these new 401k contributions will make it significantly easier for them to start offering this tax benefit. Will this rule, however, apply to any other retirement accounts besides 401ks? And the answer is yes. Under the Secure Act 2.0, 401ks are not the only type of retirement account that is now eligible for matching contributions for student loan payments. In fact, this rule will now apply to 403bs, 457 plans, and simple IRAs. So if you happen to have one of these types of retirement accounts instead of a 401k, then you'll be able to take advantage of this benefit as well if your employer offers it. If you're not familiar with 403b plans, they are qualified retirement accounts that are specifically designed for people who are employed at public schools or certain charities. So no, you do not have to work for a private sector company in order to benefit from the new rule for contribution matching for retirement accounts. 457b plans are very similar to 401ks and 403bs. However, they are primarily used for government employees, but they are also available for employees of certain tax-exempt organizations. So if you work for the government and are not a teacher, then you can also potentially benefit from the new rules for student loan payment matching as well. Here's why 401k matching for student loans matters. There are roughly 45 million people in America who have student loans. Ever since the temporary pause on student loan payments due to the COVID pandemic ended, millions of people with student loan debt have been struggling to keep up with their student loan payments. Many of these people had to choose between making student loan payments or contributing their extra savings to their retirement accounts. If people cannot afford to save for retirement, it means that they will have to work for a longer amount of time before retiring, and that they will struggle to maintain their lifestyle and or simply keep up with their bills when they do eventually retire. Now, thanks to the new rule, at least some of these people will not have to choose between contributing to their retirement accounts or keeping up with their student loan payments. For people who do get employer matching for retirement contributions, it can be an incredibly positive impact on their retirement savings and their overall financial well-being. So I'm asking you, what do you think of this new rule that allows employees to get 401k matching for student loan payments? I want to hear your thoughts in the comments. Also, don't forget to sign up for the Tax-Free Wealth Challenge by clicking on the link below in today's description. That's all for today's video. Thank you so much for watching. Like, comment, subscribe. You know what to do. I look forward to seeing you on the next video. Cheers.